Bruce Stout, it's been another outstanding year for investors in Murray International Trust, with the share price up about 25% and the premium on the shares now standing at 10%. What were the main contributors to that performance in 2012?
It's been a performance that's actually surprised us. We didn't think it'd be as strong, or markets would be as strong as they've been this year. We went into the year just looking to preserve capital, and therefore the trust remains very defensively positioned. But due to good stock selection, predominantly in Asia and emerging markets, we've continued to deliver capital growth and indeed income growth again.
Now that 10% premium is a nice boost for existing investors in the trust, but it's quite expensive for new investors and regular savers. What can you do to help those new investors and savers into the trust?
The premium has been with us now at Murray International for over 4 years, and it is something that ourselves and the board are very aware of. And we want to try to reduce it for regular savers, especially those in the monthly plans. The way that we've done it so far, and it seems to be working relatively well, is through a tap issuance. And this year we've issued £99 million in an attempt to bring that premium in.
You stated that you're quite worried about the eventual outcomes of quantitative easing measures that have taken place throughout the world. Why do you think that equities are an antidote to QE?
The main issue with quantitative easing is that the ultimate consequences of quantitative easing are currency debasement. And if governments continue to do it, then people will lose confidence in currencies. And eventually we just will not finance those deficits. Therefore, we're more likely to have inflationary consequences from deleveraging rather than deflationary consequences. And if inflation does indeed start to creep back into the system, then equities offer a slightly better hedge against inflation than bonds or cash.
These extremely low bond yields are encouraging more investors to turn to dividend-paying equities. Now, your colleagues in Asia suspect there might be a bit of a bubble growing in certain dividend-paying stocks. Would you agree with that? And could you give some examples of companies that actually offer sustainable dividend yields?
Well, we certainly wouldn't disagree with our colleagues' view that some Asian dividend stocks are beginning to look very expensive. Companies like AIS in Thailand and Siam Macro traditionally had been higher yielding stocks, but now through superior performance and are now getting quite expensive, are actually quite low yielding.
You've recently highlighted that corporate profit expectations have not been met in economically sensitive sectors of the market. What's your expectations for those sectors now?
Well, it's very, very difficult. This year we've been aware that a lot of the defensive companies have been getting more expensive. And at the margin we've been interested in adding to cyclicality. But often it's like trying to catch a falling knife, and you do get hurt if you go into cyclicals too early. Most of the profit warnings we've seen in 2012 have been around manufacturing, industrial, and of course commodity companies. So it's very much a case of trying to work out what those businesses are worth so that you can buy them when they are out of favour. But for a trust like Murray International, that's always only going to be at the margin because cyclicality and buying cyclicals is a very difficult thing to do.
And finally, Bruce, the trust is geared to around about 13%. Now, does that mean that you're still finding attractively valued companies, or that you're more positive on equities in general, or is it a combination of those two factors?
The trust is geared and is more geared into equities than it's been for some considerable time, but that is actually more a feature of how expensive bond markets are. And therefore our bond weightings are the lowest they've been for over 20 years. We do see some equities around the world that still offer decent value and have transparent growth in revenues and dividends, but it is getting harder to find. One thing that we must stress going forward is that the crisis in public sector indebtedness remains the dominant feature, clouding the macroeconomic backdrop. And as long as that persists, then markets are likely to remain nervous, markets are likely to be driven by sentiment, and therefore it will not be a smooth ride going forward. And capital preservation remains our #1 priority.
Bruce, thanks very much for talking to us today.
Thank you.